If you're holding NVIDIA stock right now, what I'm about to tell you could completely change your investment thesis. And I'm not talking about the things you're reading in mainstream headlines. This is about three major shifts happening in 2026 that Wall Street analysts are either missing or deliberately ignoring. By the end of this video, you'll understand exactly why this year could be the most volatile period in NVIDIA's history since the AI boom began. Let's get into it. Look, I need to be completely transparent with you from the start. NVIDIA is currently trading around $190 per share with a market cap hovering near $4.3 trillion. That makes it one of the most valuable companies on planet Earth. The stock has climbed over 1,100% in just 3 years. Analysts have price targets ranging from $200 all the way up to $352. And if you listen to the bulls, they'll tell you that NVIDIA is headed to $6 trillion in market cap by the end of 2026, which would put the stock somewhere around $247 per share. But here's what nobody's talking about. Those projections are built on assumptions that might not hold up when we get 6 months down the road. Let me show you what's really happening beneath the surface. NVIDIA just reported $57 billion in quarterly revenue for Q3 fiscal 2026. That's a 62% year-over-year increase. Data center revenue alone hit $51.2 billion, up 66%. Earnings per share are projected to grow almost 70% year-over-year to $1.44 for Q4. On paper, these numbers look absolutely spectacular. The company is printing money. But when you dig into the details, three massive risks are emerging that could derail this entire rally. And I'm going to walk you through each one. Risk number one is something I call the Great Memory Crisis. And this is probably the most immediate threat to NVIDIA's production capacity. Right now, there's a severe global shortage of high bandwidth memory, or HBM. This is the specialized memory that goes into AI chips. Samsung and SK Hynix are the primary manufacturers. They're prioritizing their highest margin customers, which are data center chips. Here's the problem. Gaming GPUs use HBM too, but they generate way less revenue per chip than AI accelerators. So what's happening is that Samsung and SK Hynix are allocating most of their HBM production to data center applications, because a single data center chip can generate 12 times more revenue than a gaming chip. This is already showing up in the supply chain. Multiple reports indicate that NVIDIA's RTX 50 series production could be cut by 30 to 40% in early 2026 because they simply can't get enough memory modules. Think about what that means. You've got this massive consumer demand for gaming cards, but NVIDIA physically cannot produce enough units to meet it. And it's not because they lack manufacturing capacity for the GPU itself. It's because the memory supply chain is completely constrained. NVIDIA is competing against its own data center division for the same scarce resource. Now, you might say, well, data center chips are more profitable anyway, so why should investors care about gaming cards? Here's why. Gaming has always been NVIDIA's stable base business. It's predictable, it's recurring, and it provides steady cash flow even when other segments fluctuate. If gaming revenue starts to decline because of supply constraints, it makes NVIDIA's entire business more dependent on data center growth continuing at this breakneck pace. And that brings us to risk number two. The China export situation is far more complicated and dangerous than most investors realize. Here's what actually happened. In December 2025, President Trump announced that NVIDIA would be allowed to sell H200 chips to China in exchange for the US government receiving a 25% cut of the revenue. Then, in January 2026, the Department of Commerce formalized this policy. On the surface, this sounds like good news for NVIDIA. China represents roughly 20 to 25% of NVIDIA's data center revenue historically, so reopening that market should be a huge tailwind. But there are three major problems with this. First, the approval comes with a volume cap. NVIDIA can only ship to China at levels that are 50% or below their domestic US sales. So if NVIDIA sells 2 million H200 chips in the United States, they can only sell 1 million to China. That's a significant limitation. Second, every single shipment requires case-by-case approval from the Bureau of Industry and Security. NVIDIA has to demonstrate that exporting these chips won't reduce semiconductor production capacity available to US customers, that Chinese purchasers have robust compliance procedures, and that the chips have undergone independent third-party verification. This creates massive administrative overhead and uncertainty. You're not dealing with a free market transaction. You're dealing with a heavily regulated export process where any individual sale could get blocked. Third, and this is the part that really concerns me, the Chinese government hasn't fully cooperated with this policy. According to reports, Beijing has indicated it will only approve H200 chip orders under exceptional circumstances, like for university research labs. The Chinese government previously labeled NVIDIA's H20 chip as unsafe and summoned NVIDIA to discuss alleged tracking and remote control risks, So you've got this bizarre situation where the US government says NVIDIA can sell to China, but the Chinese government is putting up its own barriers to actually accepting those chips. NVIDIA CEO Jensen Huang visited China in February 2026, touring Shanghai and Beijing. The company secured approval to ship about 80,000 H200 units initially, with plans to deliver up to 400,000 chips total. But think about the political risk here. You've got bipartisan pushback in Congress. Senator Elizabeth Warren and Senator Tom Cotton introduced legislation to limit chip exports. Representative Brian Mast advanced the AI Overwatch Act, which would require congressional approval for advanced chip shipments within 30 days, giving lawmakers the power to block sales. This isn't a stable policy environment. This is a political football that could change direction at any moment. If Congress decides to tighten restrictions again, or if US-China relations deteriorate for any reason, NVIDIA's China revenue could get cut off overnight. And remember, we're talking about potentially 20 to 25% of their data center business. That's not a small risk. It's a fundamental uncertainty in their revenue model. Now let's talk about risk number 3, which is intensifying competition from both expected and unexpected sources. AMD just announced the MI325X accelerator as a direct competitor to NVIDIA's H200. According to recent analysis, AMD's data center revenue nearly doubled in 2024, and they're winning contracts with major customers like Microsoft, Meta, OpenAI, and Oracle. AMD's MI350 series, launching later in 2026, is specifically designed to challenge NVIDIA's dominance. But here's where it gets really interesting. In February 2026, NVIDIA and Intel announced a historic collaboration. NVIDIA is investing $5 billion in Intel's common stock. Intel will design and manufacture custom data center CPUs with NVIDIA NVLink integration, and Intel will build x86 system on chips that integrate NVIDIA RTX GPU chiplets for personal computing. On the surface, this looks like a partnership. But if you read between the lines, it's also NVIDIA hedging against supply chain risk and Intel trying to claw back relevance in a market where they've been losing ground. The fact that NVIDIA feels the need to invest $5 billion in Intel and create custom chip designs tells you that their current supply chain and manufacturing relationships might not be sufficient to meet future demand. And then you've got the hyperscalers building their own custom AI chips. Amazon has its Graviton line of processors. Microsoft announced Cobalt CPUs. Google is developing Axion processors. These are all alternatives to buying off-the-shelf chips from NVIDIA. The more that cloud providers develop in-house silicon, the less dependent they are on NVIDIA for their AI infrastructure. This doesn't mean NVIDIA is going to lose the AI chip market overnight. They still have the most advanced products and the strongest ecosystem with CUDA. But it does mean that their competitive moat is getting narrower, and they're facing pressure from multiple directions simultaneously. Now, let's talk about what all of this means for valuation. NVIDIA is currently trading at about 24 times sales. Over the past 3 years, the stock has often traded above 30 times sales. If NVIDIA can maintain that higher multiple and hit analyst revenue estimates of $213 billion for 2026, you get to a $6 trillion market cap and a stock price around $247. That's the bull case. But here's what concerns me. NVIDIA's growth is decelerating. They grew revenue by 62% year over year in Q3. That's still phenomenal growth, but it's down from the triple-digit growth rates we saw earlier in the AI boom. Analysts are projecting 50% growth for fiscal 2026, and then growth is expected to slow further in 2027. There's also the question of free cash flow and capital expenditures. NVIDIA spent $3.2 billion on capital expenditures in fiscal 2025, which is up over 200% year over year. They're building out Blackwell accelerator production and expanding AI infrastructure. That's necessary to meet demand, but it's also compressing their free cash flow margins. If memory costs keep rising, if competition forces them to cut prices, or if China revenue doesn't materialize as expected, you could see margins compress. And if margins compress while growth is slowing, that's when you get multiple compression. The stock could go from trading at 24 times sales down to 18 or 20 times sales, which would put it significantly below current levels even if revenue keeps growing. Let me give you the scenarios I'm watching for the rest of 2026. Scenario 1 is the bullish case. NVIDIA successfully navigates the memory shortage by securing priority allocations from Samsung and SK Hynix. China approves large-scale H200 shipments without major delays. AMD and Intel competition remains limited to specific niches and doesn't materially impact NVIDIA's data center market share. Blackwell and Rubin product launches go smoothly and customer demand remains strong. In this scenario, NVIDIA hits or exceeds revenue guidance, maintains gross margins above 70%, and the stock reaches the 240 to 260 range by end of year. Probability I'd assign to this scenario is maybe 35 to 40%. Scenario 2 is the base case. Memory constraints cause some production delays, but NVIDIA manages through it by prioritizing higher margin data center products over gaming. China revenue comes back, but at lower volumes than bulls are hoping for because of regulatory friction on both sides. AMD wins some market share in specific segments like inference workloads and cost-sensitive applications, but NVIDIA retains dominance in training and high-performance compute. The stock probably trades in a range of 190 to 220, with earnings driving modest upside, but valuation concerns capping major gains. Probability maybe 40 to 45%. Scenario 3 is the bearish case. Memory shortage persists longer than expected, forcing NVIDIA to cut production targets and push out delivery timelines. This would hit both gaming and data center segments. China policy becomes more restrictive again, either from U.S. congressional action or Chinese regulatory pushback, cutting off a major revenue opportunity. AMD and Intel make meaningful inroads with customers who are looking to diversify away from single vendor dependence on NVIDIA. Gross margins compress as competition intensifies and input costs rise. In this scenario, the stock could trade down to 150 to 170 as the market reprices growth expectations and assigns a lower valuation multiple. Probability 20 to 25%. Now, here's what I think is actually going to happen. I believe we're headed for a year of extreme volatility where the stock bounces between these scenarios based on quarterly results and policy announcements. You're going to see NVIDIA report a strong quarter. The stock rallies to 210 or 220. Then you'll get a headline about China restrictions or memory shortages, and it drops back to 185. This is not going to be a smooth ride. The days of just buying NVIDIA and watching it go up in a straight line are probably over, at least for 2026. So what should you do if you're holding the stock right now? First, understand your risk tolerance and time horizon. If you're a long-term investor who believes in the AI thesis and you can stomach volatility, there's a reasonable case for holding. NVIDIA is still the dominant player in AI infrastructure. They have the best products, the strongest ecosystem, and they're positioned at the center of one of the biggest technology shifts in history. But if you're someone who's heavily concentrated in NVIDIA, if it's more than 10 or 15% of your portfolio, I would seriously consider trimming that position. Not because NVIDIA is a bad company, but because the risk reward at current valuations is less favorable than it was 2 years ago. Second, pay very close attention to 3 data points in every earnings call. Number 1, what is management saying about memory supply and production capacity? If they start guiding down production targets or talking about extended lead times, that's a red flag. Number 2, what's happening with China revenue? Are they actually shipping meaningful volumes, or is it just small-scale pilot programs? And number 3, what are gross margins doing? If margins start declining, that tells you either costs are rising or competitive pressure is forcing price cuts. Either way, it's a problem for the valuation. Third, diversify your AI exposure. If you believe in the AI megatrend, but you're worried about NVIDIA-specific risks, consider spreading your bets. You could look at companies like Broadcom, which makes custom AI chips for hyperscalers, or you could look at companies that benefit from AI infrastructure build-out, like data center REITs, or companies that make cooling systems and power infrastructure. You could even look at software companies that are building on top of AI infrastructure. The point is, don't make NVIDIA your only way to play this theme. Fourth, and this is important, watch the macro environment. NVIDIA's stock performance is not happening in a vacuum. If we get a broader market correction because of inflation concerns, interest rate changes, or geopolitical events, NVIDIA will get hit harder than most stocks because of its high valuation and growth stock profile. Make sure you're not confusing company-specific risk with market risk. Here's my bottom line. NVIDIA is an incredible company that has executed flawlessly during the AI boom, but 2026 is setting up to be a much more complicated year than 2023. 2024, or 2025. You've got supply chain constraints, geopolitical uncertainty, and rising competition all hitting at the same time. The stock is priced for perfection, and perfection is getting harder to achieve. That doesn't mean you should panic sell, but it does mean you need to go into this year with your eyes wide open, understanding the risks, and having a plan for how you'll respond if things don't go as smoothly as the bulls are projecting. Let me give you one more thing to think about. There's this narrative in the market right now that NVIDIA is too big to fail, that they're so dominant in AI that no matter what happens, they'll be fine. And look, I understand where that sentiment comes from. When you control 90% of the AI training chip market, and you've got companies like Microsoft, Amazon, Google, and Meta, all dependent on your products, it feels like you're invincible. But here's what history teaches us about technology monopolies. They never last as long as people think they will. IBM dominated mainframes. Microsoft dominated operating systems. Intel dominated CPUs. Cisco dominated networking equipment. Every single one of those companies seemed unstoppable at their peak, and every single one of them eventually faced serious competition that eroded their margins and market share. I'm not saying NVIDIA is going to become the next IBM, but I am saying that assuming they'll maintain 90% market share indefinitely is probably naive. The AI infrastructure market is projected to hit $2 trillion by the early 2030s. That's an enormous prize, and when there's that much money at stake, you better believe that every major technology company on the planet is going to try to get a piece of it. AMD is spending billions on R&D to compete. Intel is reinventing itself as a foundry to build custom chips. The hyperscalers are designing their own accelerators. Even companies like Qualcomm are entering the data center market with their own solutions. This level of competition is only going to intensify. And as it does, NVIDIA's pricing power will come under pressure. They won't be able to charge whatever they want anymore because customers will have alternatives. There's also a longer-term question about the sustainability of the current AI infrastructure build-out. Right now, companies are spending hundreds of billions of dollars building out data centers and buying AI chips, almost regardless of whether they have immediate profitable use cases for them. This is classic gold rush behavior. When everyone believes AI is the future, companies don't want to fall behind, so they overspend to make sure they have enough capacity. But at some point, the CFOs and boards of directors are going to start asking harder questions. They're going to want to see return on investment. They're going to want to know what revenue these AI capabilities are actually generating. And if the answer isn't satisfactory, capital expenditure budgets are going to get cut. We saw this exact pattern play out with cloud infrastructure in the mid-2010s, with data center spending in the late 2000s, and with fiber optic networks during the dot-com bubble. There's a build phase where everyone overspends, and then there's a rationalization phase where spending pulls back. I don't know exactly when that's going to happen with AI infrastructure, but it will happen eventually. And when it does, NVIDIA's growth rate is going to slow significantly. Now, I want to be clear. None of this means NVIDIA is a bad investment. It just means you need to be realistic about the risks and the potential returns from current levels. If you bought NVIDIA at $50 a share 3 years ago, congratulations. You made an incredible investment. You're up almost 4x. But if you're buying today at $190, you're not getting the same risk-reward profile. To double your money from here, NVIDIA would need to hit $380, which would require the company to either double its revenue or significantly expand its valuation multiple. Both of those things are possible, but they're not guaranteed. You're paying a much higher price for much more uncertain outcomes. One thing I haven't talked about yet is the regulatory environment, and this could be a sleeper risk. NVIDIA has been largely exempt from the kind of antitrust scrutiny that companies like Google, Amazon, Apple, and Meta have faced. But as they get bigger and more dominant, that's going to change. The FTC and Department of Justice are already looking at potential monopolistic practices in AI infrastructure. If regulators determine that NVIDIA's dominance is harmful to competition, they could impose restrictions on bundling practices, force technology licensing, or even pursue breakup scenarios in extreme cases. Again, I'm not predicting this will happen, but it's a risk that's not currently priced into the stock. Regulatory risk tends to sneak up on dominant companies when they least expect it. And then there's the human capital risk. Jensen Huang is 62 years old. He's been CEO since he founded the company in 1993. He's a visionary leader who has successfully navigated multiple technology transitions. But succession planning is a real issue for any company that's this dependent on a single leader. If something were to happen to Jensen, or if he decided to step down, the market would react negatively, at least in the short term. Smart investors think about key person risk, especially in companies where the CEO has such a singular role in strategy and vision. So pulling all of this together, here's how I'm thinking about NVIDIA for 2026. The company is in a great position fundamentally. They have the best products, the strongest market position, and they're riding one of the biggest technology waves in history. But the stock is expensive, the risks are rising, and the easy money has probably already been made. If you own it, I'd be thinking about position sizing and risk management. If you don't own it yet, I'd be very careful about chasing it at current levels. Wait for a pullback. Wait for a better entry point. There's no rule that says you have to own every hot stock at every price. Sometimes the best trade is the one you don't make. Watch the Q4 earnings call closely. NVIDIA reports on February 25th, 2026. That's going to be a critical inflection point. If they guide above expectations and show that they're successfully managing the memory shortage and China situation, you could see the stock break out to new highs. But if there's any disappointment in guidance or margins, you could see a sharp correction. Either way, volatility is coming. Be prepared for it. Have a plan. Don't get caught reacting emotionally to big price swings. If this analysis was helpful, make sure you hit that subscribe button because I'll be tracking NVIDIA closely throughout 2026 and breaking down every earnings report and major development as it happens. Drop a comment and let me know if you're holding NVIDIA stock and what your strategy is for this year. Are you buying more on dips? Are you trimming? Are you holding steady? I want to hear from you. And if you found value in this deep dive, share it with someone else who's invested in NVIDIA or thinking about it. This is the kind of analysis you're not going to get from mainstream financial media. They're just going to give you the surface level bull case without digging into the real risks. That's what we do differently here. We go deep, we look at the numbers, we think critically, and we don't just tell you what you want to hear. We tell you what you need to know to make better investment decisions. Thanks for watching, and I'll see you in the next one.